All right, you've done everything right. You've saved, you've invested, and now you're getting close to retirement. But there's a bill headed your way that almost nobody warns you about. And the worst part, you may have already triggered it, even without knowing. It's called IRMAA, and for some retirees, it can add $10,000 or more a year to their medical costs every single year. So today, we're going to break down exactly what IRMAA is, who gets hit with it, and most importantly, the moves you can make right now to keep it from wrecking your retirement budget. But first, what is IRMAA? Well, IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on top of your regular Medicare Part B and Part D premiums that kicks in if your income is above a certain level. And here's the part that gets people. It's not based off of what you made last year. It's based off of what you made 2 years ago. So that 2-year look back is the trap that catches so many high earners off guard. If you think you're in a low income year, you feel good. And then a letter shows up from Social Security and your Medicare bill is suddenly hundreds of dollars higher every month for the whole year. My name's Steve Borstein, and I'm a financial planner. And this video is for educational purposes only and does not constitute individual investment, tax, or legal advice. Always consult with your tax professional or your financial planner. And if your advisor isn't talking to you about IRMAA, contact us. It's exactly the kind of thing that we help clients navigate in their financial planning every year. All right, so let's get into it. I want to walk you through the 5 most common ways people accidentally trigger IRMAA and what you can do to protect yourself. So trap number 1, the Roth conversion ambush. Now this one's incredibly common. I've done a whole video, actually 2 different videos on Roth conversions, and I'll link to it below. But the short version is this. When you do a Roth conversion, the amount you convert gets added to your modified adjusted gross income for that year. By the way, some people abbreviate this as MAGI, or fans of Rod Stewart might call it Maggie, or around Christmas you might call it Magi. However you pronounce it. If you have enough modified adjusted gross income, you could trigger IRMAA. For many people, that spike in income looks like a great tax planning move in the moment. But then 2 years later, when Medicare looks back at that income, they see someone who looks like a high earner, even if you were retired living on very little. So here's the critical part. For 2026, the IRMAA surcharge kicks in for individuals with a 2024 MAGI of over 109,000, or for married couples with a MAGI of over 218,000. These thresholds are adjusted for inflation each year, so always check the current numbers. And these aren't soft limits where you gradually pay a little more. They're cliff brackets. Go over by one single dollar and you jump into the next tier, all at once. The smart play is to model the 2-year impact before you pull the trigger on any large Roth conversions. This is why working with a financial planner on the timing of conversions isn't just nice to have, it can save you thousands. Trap number 2, the one-time income event. Well, maybe you sold a business. Maybe you had a big capital gain from selling a rental property. Maybe you got a severance package. These one-time events feel like victories, and they are, but they can quietly set an IRMAA trap that springs 2 years later. So here's why it stinks. The business owner might retire, let's say 63, have one big final income year, and then cruise into Medicare at 65 thinking life's good. And then the letter arrives, a massive Medicare surcharge based on income they haven't earned in 2 years. For many people, this situation, the income event, was unavoidable. But the key is anticipating it. If you know you're going to have a high income year 2 years before you turn 65, that's information that you could potentially plan around. Trap number 3 is the required minimum distribution trap. Under the current law, most people have to start taking required minimum distributions, or RMDs, from their traditional IRAs and 401ks at age 73. Always confirm the current rules with your tax professional, as these ages have changed in the past and they're going to change in the future. Now here's the problem. Those RMDs are taxable income. And for someone who has done a good job saving $1 million, $2 million, $3 million in pre-tax accounts, those RMDs can be significant over time, easily pushing you above IRMAA thresholds year after year. This is why one of the most powerful things you can do during your gap years, the years after you retire but before Social Security and especially RMDs kick in, is to strategically convert some of that pre-tax money to Roth. Paying the tax now at a lower rate to reduce the RMDs you'll be forced to take later could be a smart move. It doesn't necessarily eliminate IRMAA, but it can help you manage the size of the problem. Again, this is a strategy that depends heavily on your specific situation. The math needs to work for you. So if you're finding this helpful and it's clicking for you, please do me a favor and click the like and subscribe button. It helps us grow this channel. Trap number 4, Social Security timing. Now here's the one that surprises a lot of people. If you delay Social Security, which is often a smart move, you can end up in a lower income window during your early retirement years. That's actually great for IRMAA planning, But once Social Security turns on, especially if you're taking RMDs, your income can jump up significantly. The year that both Social Security and RMDs start hitting your tax return at the same time is the year many people first get smacked with IRMAA. That's the year you want to have already planned for, not reacted to. So timing your Social Security claim is an important personal finance decision. It depends on your health, your spouse's situation, your other income, and a dozen other factors. But understanding how it interacts with IRMAA is a part of that conversation. Trap number 5, ignoring the appeals process. This one isn't about triggering IRMAA. It's about what to do after you've been hit. And most people don't know this option exists. If your income drops significantly because of a life-changing event, retirement, divorce, loss of a spouse, loss of income, you can appeal your IRMAA determination. Social Security calls these life-changing events, and they allow you to request that your premium be recalculated using more recent income information instead of the old 2-year data they normally use. So listen up, because this is an important part of this whole conversation. If you retired in 2026 and you know your income dropped dramatically from 2024, do not just accept the IRMAA letter. You may have grounds to appeal and have your premiums recalculated. This is an area where a financial advisor and your tax advisor can help you navigate the process, but you have to know to ask. So now let's zoom out for a second, because I want to talk about what this really means. Medicare is supposed to be one of the benefits that you've earned after a lifetime of work. And for most people, it is. But IRMAA is a reminder that the government's definition of high earner doesn't always match reality. Maybe you had one big income year because you sold something you built over decades. Maybe a Roth conversion made financial sense for your long-term plan, but triggered a short-term premium spike. The income that IRMAA sees on paper and your income that you're actually living on in retirement can be two very different things. That disconnect is exactly why planning ahead matters so much. The goal isn't necessarily to avoid IRMAA forever. For some people, it is unavoidable. The goal is to understand it's coming, plan for it, and not be blindsided by a letter that feels like a punishment for everything you've done right. So let me bring this home. We covered 5 IRMAA traps that catch retirees off guard. Trap 1, Roth conversions that spike your income in the wrong year. Trap 2, one-time events like business sales or big gains. Trap 3, RMDs that push your income over the threshold every single year. Trap 4, Social Security timing and how it compounds the problem. And trap 5, not knowing you can appeal when your circumstances change. The question I want you to sit with is, do you know what your income is going to look like in 2 years from now? Not just this year, 2 years from now in retirement, because Medicare is already watching. If you have questions about your specific situation, drop them in the comments below and I'll do my best to point you in the right direction. And if you want to go deeper into the Roth conversion side of this equation, check out the video on the biggest Roth IRA mistakes high earners make. And if you think we can help with your planning, click the link in the description. I'd love to have my team sit down with you and take a look at your numbers. My name is Steve Borstein. I'm a financial planner, and you're watching The Personal Finance CEO.